Hello, greetings, and welcome to Dividend Blasters. This is somewhat of a momentous occasion for our channel. This is our 10th video. Couldn't be more excited. Anyway, topic of discussion today, the Dividend Kings. If you invested in a Dividend King several years ago, you'd be doing very well. So, I'm going to go through and I'm going to talk a little bit about what a Dividend King is and who they are. Before we start, I'd kindly ask if you'd give our video a like, subscribe to our channel, it's free, and feel free to share it with a friend, the video. Disclaimer, I'm not your financial advisor. The purpose of this video is for information and education. It reflects my own personal opinions. So please do your own research and consult a licensed professional financial advisor prior to making any financial decisions. I must say that I've been an investor for more than 30 years. However, before making major financial decisions, I also consult my licensed professional financial advisor regularly. Okay, what is a dividend king? A dividend king is a firm that has paid and is continuing and currently paying an increasing dividend for the past 50 consecutive years or more. This is something of a huge accomplishment. A lot of firms haven't done this. Most firms cannot do this and don't do this. There are currently 42 companies in our list. What is a dividend aristocrat? Now, I need to talk about a dividend aristocrat before I can really talk about a dividend king. Because the dividend aristocrat list actually, I believe, originated with S&P Global Inc. several years ago. It used to be known as McGraw-Hill. They came up with the dividend aristocrat list, and in their list, they included firms that had paid at least 25 consecutive years, but also included firms that were 50 years or more. Anything more than 25 years. But there were also a couple other criteria. They had to have a market cap of greater than 3 billion, and they also had to be traded in volume of at least 5 million a day on average for 3 months before getting the designation aristocrats. So because of these extra criteria, and it's really a matter of scaling and size, some of these firms that are dividend aristocrats that haven't reached the 50-year mark are much bigger and much better known than some of the dividend kings. Not all of them, but some of them. And you'll see that when I show you the list of the kings. Um, there are 43 companies on the dividend aristocrat list. So there's 42 on the king list, 43 on the aristocrat list. I'm planning to do another video on the aristocrats in the future. So we will wait for that. But right now we're going to talk about the kings. The dividend kings. All right, I'm going to show you the list. It's two screenshots, and I've broken it out half and half. Bottom half first. Okay, so I am showing uh, half the bottom half of the list, so 42 through 22. And what I've done is I've given them really kind of a notional ranking, and I'm not ranking them by best to worst or anything like that. I'm just ranking them by the length of the dividend increase. So whoever is has been doing this for 50 years and maybe 1 month or maybe 50 years in one day, they're going to get number 42. Who's ever a day more than that, they're going to get number 41, and so on and so forth. And I worked my way up to the list to number one on the second slide. So that's where the ranking comes in, and I came up with that. I got most of this list from my trusty resource, the Motley Fool, but it didn't have all the information I wanted to share. I heavily leveraged Seeking Alpha, another wonderful resource, and a little bit from my TD Ameritrade brokerage account. So you see the company, you can see the ticker symbol in the second column. Uh, you can see the exchange. A lot of them are New York Stock Exchange. Uh, and you have the industry sector. A lot of industrials, a lot of consumer goods. But on this page, a lot of industrials, a lot of healthcare. You're going to see more of that on the next page too. They're all dividend kings. I really didn't even need to leave that column in, but I did. I got the PE ratio, so you can get a sense. Um, if you do decide to do a deeper dive, or if we together on this channel do a deeper dive, we can take a good look at the price to earnings ratio and see how they compare to their competitors in their industry sector. Um, I, of course, included the dividend yield percentage. And as you know, if you've listened to the other videos, I've included the dividend growth rate for the past 5 years. And why did I do that? Because I like to see a combination of the two, lower yield, higher growth rate, to come in or around 10%, kind of a rule of thumb that a lot of us dividend growth investors look for. And I think you'll see why when I show you some analysis I did on this. Dividends per share is another metric I'm showing, and earnings per share. Why am I showing you those? Because that's how we derive the dividend payout ratio. And another metric that rule of thumb is that we look for 20 to 60%. I've mentioned that that's the rule of thumb, and that sometimes I look really around 20 to 80%. But after having looked at this, uh, I would say I'm probably more 20 to 60 and less 80. I may go to 80, but I think it gets a little risky because you want to be investing in a company that's not overextending themselves and has the cash and the reserves to maintain that growing dividend for a long, long time for you, their stakeholders. I have the frequency of the dividend, and I will tell you that every one on this list is quarterly. I don't remember seeing any monthly. Maybe there was one semi-annually. But anyway, this to get to this level, that may have been before they had monthly dividends. I don't know. Um, but anyway, you can take a look at that. What you see on this first page. Look at the dividend yield. With the exception of a couple, I see the Altria Group, which I love, which is a tobacco company, and Universal Consumer Goods. That's I believe, the movie production company. Um, they're fairly small. They're all in the 1 to 2 to 3% range. When you look at the dividend growth rate, the figures are much larger. There is a pattern here, and I think it's probably echoes what I've been echoing, and it's a successful rule of thumb. Lower dividend yield, uh, bigger dividend growth rate. Look at the growth rates: 8.49, 9.38, 7.52, 5.62. They're much, much, much bigger. Um, you know what? Take a look at the payout ratios. I see a couple larger ones. I see one for almost 74%. SJW Group, but that's a utility. I think they tend to go a little high. There's another big one, Universal. So they have a high dividend yield and they have a high dividend payout ratio. That stands to reason. I'm not really surprised by that. There's one that sneaks right by 60%, but let's not talk about that. That's just 0.4%. I would say, well, there's one more, PepsiCo, 66.64%. So not much. Oh, and Kimberly Clark, okay, the consumer goods company, 82.42. So there's maybe three companies or so that are a little bit above and beyond, but in that first 42, most of them are in line. They're not really breaching 60. There's a few that are breaching it a little bit, but most of them are below. Um, let's see, what else do we want to talk about? I got the dividend per share and the earnings per share, so you can get a sense in dollarized whether the company is covering the dividend. Good rule of thumb: look at the earnings per share in dollars compared to the dividend per share. Uh, Most of these, all of these, I believe, yeah, they're making it. They're exceeding it. I would say if I were to see something that said, "Whoa, there's an earnings per share that's less than the dividend per share," there's something wrong. Maybe they're reaching into the reserves to make a dividend payment, or there's a typo. But these companies are making it. As an aside, and I don't know if you've read the headlines recently, but Intel Corporation, not on this list, and I used to be a big admirer of them, cut their dividend by 65%. It's a sad thing to say. I used to own a lot of shares. I only have a handful of them now. But I hate to say how the mighty have fallen. I hope they come back, but it's really quite devastating to see it happen. Anyway, that was just more of an aside. Let's go to this first top half of the list. Top half of the list. So, do you see any companies that you recognize? I do see a REIT at the bottom. And one thing I will mention is, and it's called Federal Realty Investment Trust. Now, this is a Dividend King. Take a look at their dividend payout ratio. And I put this here for illustrative purposes, but that's what it is. It's almost 162%. Why did I put it there? To illustrate to you that it's not a valid metric for REITs when evaluating how they are at doing dividend payouts. You typically need to look at things like funds from operations, which is like cash flow, uh, and price over funds from operations. And so you kind of need to look at those. I have those in here, but I have them in the PE ratio and in the EPS ratio. So, um, but that dividend payout ratio is not a good metric for the simple reason normal rules don't apply to REITs. REITs do not pay federal income tax. They are exempt on the condition that they pay out at least 90% of their profits in dividends. And that's why REITs are so popular with dividend growth investors and retirees. They're going to get a steady, stable dividend, and it's pretty guaranteed. Now, Federal Realty Investment Trust, I'm very familiar with it. I don't own any shares, but I do own shares in Realty Income, ticker symbol O. And they just raised their dividend, and they're a dividend aristocrat. They have increased their dividend for 26 consecutive years, and it's a very popular REIT. Another popular REIT is Stag Industrial. Uh, Not quite yet there, but very good, and they're more of an industrial REIT. And I may do another video just on REITs. I think that would be a good topic. Let's see. Steppen and Company, I am not familiar. Stanley Black and Decker. Well, we know what Stanley Black and Decker is. That is the tools company. They recently, a few years ago, bought DeWalt, which are some fine tools that I use. Um, Interestingly, their dividend per share is greater than their earnings per share. That's one of the anomalies that I look at, and I would do a deeper dive and want to know, why is their dividend per share greater than their earnings per share? I would take a look at that. I did start to look, and I was reading in Seeking Alpha, and if you have Seeking Alpha, they have annotations typically around companies where there may be a risk of the company not performing well. Well, they had that. And that was as far as I went. I wanted to get the video out. I didn't go deeper, but I will. And I certainly will if I were to decide to even consider buying any shares in SWK. California Water Service, that's a utility, and they have a nice growth rate, and their dividend payout ratio looks like it's 66%, not bad. ABM Industries, that's an industrial company, low payout ratio, 21%. Hormel Foods. Now, I am familiar with this. I don't own any shares in this. This is a consumer goods company. I do know that Warren Buffett does own a significant piece of this company. He may even own a controlling share um, as part of Berkshire Hathaway. I'm not sure, but I know he's talked about it along with Coca-Cola, a couple of his favorite stocks. Um, Earnings per share 188, dividend per share 110. They've been doing it for 56 years. They have a very nice dividend growth rate of 8.63%, and their dividend payout ratio is within that 20 to 60% range. Good God, look at the one right above it. Farmers and Merchants Bancorp. It's a financials company. It's a bank. Look at the cost, the price of one share, $1,011. And it's got a low PE ratio. Wow, they must be doing something right if they're commanding that price with that low PE ratio. They have a very low dividend yield, but since the price is so high, the dividend is $16.60. Earnings per share is over $90. So they have a low dividend growth rate, and it's only 3.5%, and the payout ratio is less than 18%. I'm curious. I'm going to have to look at this. When I see a stock that sells for that much, I get curious. I wonder how did it get that expensive and that pricey. Let's see. What else do we want to talk? And you know what? You can look at these through your leisure, but what I'm doing is I'm just picking out some of the interesting ones to share with you. And really, the purpose is to give you some insight. If you don't have access to this list, here it is. And I've added some additional data points for you so to help you start to do an evaluation. And I would like to do a deeper dive in some of these. Colgate Palmolive, the consumer goods company, they have a dividend yield is 2.53% and a growth rate of 3.28%. And dividend growth rate just a little bit of, or the payout ratio is just a little over 62%. Coca-Cola. You know, I do love that stock. I don't own it now. I used to. I owned it for years, and I sold it because I did need to get a little cash to put down some money on a home improvement that was very important. So I sold my Coke stock, but I think I'm going to go back. I've been thinking about it for a while, and let's see. You know, that price does not look right. 49.98. I think it's 59.98. I'm going to have to double check that. But the rest of it is spot on. And and I actually, the reason why I noticed that is because I just did a video on three companies that just increased their dividend yield, and one of them was Coca-Cola. The other one was Louisiana Pacific, and the other one was NextEra Energy. But anyway, the reason why I'm thinking about this is their payout ratio is almost 71%, and you know it's above the 60% threshold. But I kind of go back to but it's Coca-Cola. You know, it's a marquee brand. And look, they've been doing this for 60 years. Um, The earnings per share is more than sufficient to cover the dividend, 259 versus $1.84. The dividend growth rate is not bad. It's not too high, so I don't think they're going to break the bank. Certainly. Oh, Johnson and Johnson. Now I do own Johnson and Johnson. This is a wonderful dividend king. Um, the PE ratio is 15. That is not bad. Their dividend yield is 2.86%, and I do like that growth rate of 6.11%. Oh, and the P ratio is less than 44%. You know, I really like that stock, and as I've mentioned, I've talked about it a couple times in videos. You go in your bathroom, you go in your medicine cabinet, you're going to be hard pressed not to find a product that you have that's not made by Johnson and Johnson or sold by Johnson and Johnson. Oh boy, you know what? Cincinnati Financial, and I hadn't really been aware of Cincinnati Financial until maybe 3 or 4 months ago when I started doing more research lately on dividend growth investments. I mean, my understanding is that this is this is a regional bank. But look at this. They've been increasing their dividends for 61 straight years. They got a nice dividend yield of 2.4%, and that dividend growth rate is 6.65, so that's right around 9%. The payout ratio is a little bit higher, 65%, but you know what? Look at the earnings per share, 533, more than enough to cover the $3 dividend. 3M, we're all familiar with 3M. They make everything. I mean, oh my God, they make tape. They made discs and all sorts of stuff. You go into a Staples or an Office Depot, you're going to find 3M products everywhere. They've been doing this for 64 years. They got a fairly decent PE ratio of 12.62. Dividend yield is nice, almost 5.5%. And the dividend growth rate, well, it's a little lower, but it's a healthy 4%. You know what? I could take that. I would probably just do a little bit more digging to check out the price and the PE ratio against some of its competitors. That's just kind of how I roll. But I like it. It's a big company. Emerson Electric. I used to have an Emerson Electric radio as a kid. That's, but I don't have much more insight into that company. But let's take a quick look. The dividend yield 2.54, the growth rate 1.41. I'm not crazy about that, but the payout ratio is not bad. The PE ratio is 20. I'd have to take a look at other electric manufacturers of radios and other stuff in their industry sector and see how they compare. Parker Hannifin, I am not familiar with them, but boy, they got a nice growth rate of 15%, and the yield is small, and that helps. And they have a low payout ratio. When I see that, the low yield, the increasing dividend growth rate, and the low ratio, that tells me they're going to be able to pay their. I mean, if they don't have any business problems, they're going to continue to pay out dividends and increase them. Everybody knows Procter and Gamble. That's another marquee brand. Again, you're very unlikely to find things in your bathroom or in your house that are not made by Procter and Gamble. 66 years, so 2.61% dividend yield, 5.78% growth rate. The payout ratio is a little bit more than 60%. That's not bad. Um, you know, I would. One of the things I'm going to show you is that the the companies that exceed the 60% ratio are mostly in the 61 to 66% range. And not a lot of the Kings go much above it. There may have been a couple, like I know Altria Group did, and Coke, I think, was around 70. Altria, I think, was around 82. Um, I think those are special products, though, that have a demand, a captive market demand that maybe a different rule applies to them. I don't know, but they're still doing so well. Genuine Parts, I'm sorry, I'm just not familiar with them, but I want to find out more. Um, Decent payout ratio, 43%. Got a couple utilities here up in the top. Northwest Natural Holdings, dividend yield 4%. Dividend growth rate looks kind of anemic. I'd have to take a closer look. And American States Water, they are at the top. They have been doing this for 68 years. Dividend yield 1.71. Dividend growth rate 9.11%. So American States Water is a utility, ticker symbol AWR. I think if you guys want homework, I'd say let's take a look at AWR. Let's find out more about it. I mean, you know what? Any and all of these stocks are doing the right thing. They're continuing to increase their dividend. And if you were an investor in Johnson and Johnson or Procter and Gamble or Hormel Foods, and also I love, of course, Coca-Cola and Pepsi, but I love Altria, the tobacco company, and some folks may have a problem with that, but they make a lot of money. They also own Budweiser. If you had invested in those companies 20 or 30 years ago, you'd put maybe $5,000 or $10,000 in them, or had a continued, um, investment annually and continued to drip. You would be sitting on a big dividend snowball. Your holdings would be big. Your dividends would be pretty massive. So I'm gonna, I would urge you take a look at this list and check out some of these. And you know what? If you want, leave me a comment on the channel. If you want me to go through some of these, I'd be happy to. I'm planning on doing some of them, and I got a idea of the ones that I like, but I want to hear what you guys like too. Those are the list of the 42 dividend kings. Let me just give you my quick assessment um, of the breakout of these companies. Again, these are the most successful dividend companies in the world right now. The vast majority of them are industrial companies. You go back at the list, and you're going to see a bunch of industrial companies, followed by consumer goods companies. Okay, so like the Procter and Gamble's and the Johnson and Johnsons, um, those companies, if you will. There's a handful of utilities, and then it starts to trend down. Healthcare, financials. There was one energy company. I guess I didn't put the number there, but I remember one energy company. We didn't see any big oil companies. They're not there yet. There are a handful of big oil companies in the aristocrats list, which we'll cover at a future date, but none on this Dividend Kings list. One real estate, one materials company. I did another really slice of the data here, and I wanted to give you a sense, and also want to drive home the message of what I think is important of companies that have a combination of the dividend yield plus the dividend growth rate of greater than or equal to 10%. And I found 15 of the companies, so there's 42. 15 of them, more than a third, do that, and five of them were consumer goods. And this is the list: four industrials, two healthcare, two utilities, one financials, one consumer staples. So if you know what, you see the list, you're going to recognize some of them. I see Pepsi Co., Abbott Labs, AbbVie, Target, Altria Group, Cisco is in there, Hormel Foods. So those are the ones. And then, of course, look at the top one, American States Water. I am really excited and interested in digging deeper in that one. So let's set that aside. So, and then I took a look at the companies that were within the 20 to 60% range of the payout ratio. And let's see, 24 of the 42 were in that range. So that's more than 60%. That's quite a bit. Um, the ones that were outside of that range, three of them had a payout ratio less than 20%. So you could actually say that 27 of the 42 are in a very safe range. Okay, so that might be closer to 80% now. So then the ones that were above 60, there were eight between 61 and 70. I didn't list them here, but you can go and look at the list. You'll see it on the first those two slides. And there were six between 73 and 80. And then there was the one REIT. So I would say that of the 42, there's probably six and maybe half of the eight. So maybe 10 that are, in the 65 to 83% range. And we don't count the REIT. But the rest are really fairly adhering to a 2060, you know, payout ratio. This actually is a slide from a previous presentation, but I left it in there because I think there are some lessons here, and I wanted to share them again. If you're an investor, and I know you are because you're listening, is to invest in dividend growth stocks with a history and a practice of increasing their dividend. Start early. Time is your friend. Contribute often. reinvest 100%, and drip, drip, drip. Friends, that is the end of our video. I thank you for sticking with me, and I hope you found this informative and entertaining and got some enjoyment and some knowledge out of it. I'd kindly ask, give this video a like and subscribe, and feel free to share it with a friend. Have a great day.